It's my true honor to introduce an idol of mine, Dave Wheel, former vice chairman of NASDAQ, whose work has been a great inspiration to me, and I always enjoy watching his presentations, and I'm sure you will too. So, thanks.
Thanks, Darren. So I'm going to do a little bit of benchmarking. I'm going to review a few slides that people have seen before. I'm going to go through some things that just to kind of set the table a little bit. But before I do that, I want to see a show of hands. How many people in this room know what a tick size is? Hey, that's terrific. Okay. It's the smallest increment that you can quote a stock in public markets, public equities markets. That's a penny. How many people know what a spread is in markets, a trading spread? Okay. It's the difference between bid and the offer. So typically, spreads can be larger, and they frequently are, than tick sizes. And so in the U.S. equities market today, we have a problem, which is that because the tick size increment is a penny universally across all stocks, okay, even though stocks, micro-cap stocks may trade with higher spreads, anybody can penny jump you. They can get in front of you for a penny. So there's no way for a market maker, even though there may be a 10-cent spread in the stock, to monetize that and take risk to facilitate liquidity in stock markets, okay? This is a crisis. Now, there's a big debate, and a lot of people don't understand this. There absolutely is causality when you look at IPO markets. We wrote a paper for the Organization of Economic Cooperation and Development. We looked at the 26 largest, the OECD, we looked at the 26 largest IPO markets in the world. And the United States, for small IPO production, weighted for our GDP, was the 12th on an absolute basis, the 12th largest, on an absolute basis, the number one IPO, small IPO market in the world, as it should have been for having the largest GDP back in the 1990s. And then it fell on an absolute basis to 12th. But on a GDP-weighted basis, out of the 26 largest IPO markets, we are now 24th out of 26th, ahead of only Mexico and Brazil. Okay? That's a national disaster. Because when you're looking at exits, and this is, I know this market is, this group is focused on private placements and crowdfunding, but the fact of the matter is, in order to get capital into private markets, you need money taken off the table from liquidity events. And if you raise the bar to take companies public, okay, you're not going to ultimately be successful. Ray Rothrock, who is general partner at Venrock, the venture capital fund, says that it takes an IPO market to keep it takes an IPO market to keep the M&A market honest, right? Valuations are harmed in M&A exits as the population of listed companies, the buyers, declines, and as the competition for the purchase of companies declines. And we're seeing that throughout the market. Now, many people will sit there and say that this is not a profound problem. I'm going to just show you some of the statistics. They make me want to retch. And I'm going to tell you very simply that we have blown an enormous hole in the side of the U.S. economy, largely because of hubris. Okay? Some of the folks know, and I've been, people have called me the father of the Jobs Act. We've written quite a bit of thought leadership, and if you want to find any of the papers, go to issueworks.com. There's a thought leadership tab. It has some of our congressional testimony in front of the House Financial Services Committee. It has the studies that we published. By the way, it says that we're associated with Grant Thornton. That relationship ended on September 30 so that we could focus on building IssueWorks. And I'll tell you a little bit about what we're trying to do with IssueWorks. On the one hand, public policy, we're trying to increase economic incentives to get market makers to bring capital back in to the public markets, drive liquidity in small markets, bring the IPO market back up to levels that will at least replace what's lost every year. People are saying that this is a great IPO market. It's a farce. Okay, only 11% of IPOs that are getting done this year so far are sub $50 million in size, small IPO market. There's been an absolute sort of loss of small IPOs from the U.S. economy. So this is a slide that was put up in the House Financial Services Committee, an earlier rendition, and what I want you to focus on, it's actually pretty famous at this point. If you go back to the 80s, you're going to find that 80% of all IPOs, the blue tranche, were sub $50 million in size. If you adjust for inflation, here's the gray tranche, you're going to find that all of a sudden there was sort of a cataclysmic event, an extinction class event, where suddenly there was a shift downward and the small IPO kind of left the market. It's now about 20% of the market, 30% max. This year it's running at 11% of the market. What happened was there were two major changes in market structure. The order handling rules in 1997, regulation ATS. There was rattling of sabers going on about price collusion or price fixing in the NASDAQ market makers back here from a study that was published by Professors Christie and Schultz in 1994. And then suddenly, with the implementation of Reg ATS in 1998, there was a real drop-off in small IPOs and it never recovered. Does anybody know what Reg ATS is?
Automated trading system.
What is it?
Or alternative trading system.
Alternative trading systems. That's right. It's when we effectively took electronic markets and made them, we shifted from what was largely a telephone quoted market with some electronic aspects at that point to a universally sort of electronic order book market. And what happened was tick sizes started to determine what the economic incentive was. It was no longer the quarter point telephone quoted spread. It was these minimum tick sizes of a 32nd or a 16th, 3.125 cents. So all of a sudden, boom, massive collapse at the same time in economic incentives, at the same time that we had a rise in the internet and self-directed discount brokerage models where retail commissions also went from about $250 a round lot trade down to $25 and today maybe $5. So if you look at it, 96% is what we estimate of economic incentives were just taken out of the market to support small micro-cap stocks. Now if you go to the academic literature, okay, there's two types of markets. There's massively innately liquid, what they call symmetrical order book markets, lots of buyers to offset lots of sellers at any point in time. And then there's asymmetrical order book markets, which is the way that micro-cap stocks exist. Big buyer, no seller, big seller, no buyer. And you need an economic model for a market maker to commit capital to take on that risk to facilitate liquidity. And if that doesn't happen, then institutional interest in micro-cap stocks starts to decline, and institutions start moving up the market, and we end up with an increasingly a decrease in valuations, lower and lower interest in companies going public, and we see shrinkage in stock markets. So this is exactly what we've seen in the United States. This was another slide that was put up in the House Financial Services Subcommittee on Capital Markets. And if you go back to 1997, the order handling rules and Reg ATS in 1998, you'll see that we've had a decline in the number of listed companies in the United States now every single year for 15 consecutive years. Okay, we estimate that it takes over 300 new listings just to stay even. And this year, in what the press is calling a great rebound IPO market, we'll probably do about 200 IPOs. So we're not even at replacement levels. Now, because we've got a massively supported market with all this Fed-induced liquidity, stock prices are up, delistings may not be what they are traditionally, so maybe we'll get to par, maybe we'll actually increase a little bit for the first time in 15 years. But the trend is inexorable if we don't make a change, okay? It's going to continue to be on a downward trend. So this is some data that we took from the CFA Institute. They sort of took our stuff and went all the way back to the 1970s, 1975. And what you see here is the U.S. listings trend. And you can see that today we have fewer listed companies in the United States than we did in 1975. Okay? I think that's 10 million jobs. Okay? It's really rather palpable. And the thing that amazes me, talk about hubris, is that if you go to 1997 and 1998, the order handling rules and Reg ATS were implemented without so much as a pilot program. They just did it. One of the most massive structural changes in the history of U.S. stock markets. They didn't even test it. They just did it. They thought that everything was wonderful because we were in the middle of the dot-com bubble. Okay? And we blew a hole in the side of the greatest capital formation engine innovation machine that ever existed on the face of the planet. Now, interestingly, when I go over to Europe and I speak for the OECD or around the world, what they're concerned about is that these electronic market structures with low tick sizes are starting to undermine capital formation in their markets as well. Okay, so we're seeing it in Europe, and actually the United States, Europe sort of followed the US first. We've got it in Asia, but you can see that the trends in listings, that the United States, it should be all the way up here at close to 13,000 listings if it had stayed on the same growth trajectory, and instead we're down here below 5,000. This is something we did for TEDx, but it basically shows, infrastructure, and these in 1994 were all of the companies, all of the investment banks that did at least one lead-managed IPO, one book-run IPO. Now, this is the list today, and we've basically, seen. Sorry, that's wrong. We've had that header right there should say down about over 70% at this point in time. So I apologize for the mistake, but you can see that all the red are investment banks that are no longer in business, have been consolidated out of business. We're not creating enough economic incentive in the cash equities market to sustain the infrastructure. So just like if we didn't have tolls and taxes to pay for bridges, roads, and tunnels, we're in the midst of an absolute broad-scale collapse in small cap markets, and this is one of the things that we've been fighting to effectively reverse. Now, we call this the canary in the coal mine. It is IPO performance rates or success rates. It's defined as a deal that gets done within the original filing range. It's done within 365 days of being filed at the SEC, and it's trading at or above issue price 30 days after the offering. So, reasonably decent outcomes for CEOs and CFOs. And it's just a simple trailing 30 IPO linear regression. I was talking to Mike Piawar when he was working for, I think, Senator Shelby at the time, and Mike said, well, it's not exactly the way I would do it. He's now a commissioner at the SEC, and he said, but I'm looking at it, and he said, I can tell just by looking at it, it's pretty significant. Okay, so I'm not a mathematician, don't pretend to be, but I will tell you here that, that is a massive secular decline, okay? And what's going on is that, as you all kind of know from sheer force of your own experience and logic, that the maturity of these companies is dramatically higher today in the sample set. So they should be doing better, not worse. So this is kind of just a concept chart of a little bit of what we think is going on. Larger cap, widely known, big brand names, they work because they create their own visibility. They sort of market themselves. So, Twitter goes public, no problem getting an audience. Its business model allows it to have lots of connectivity and impressions with lots of individuals. It stokes demand for its shares, LinkedIn, all the social networking stocks, the big sexy brands like Tesla Motors. But the vast majority of companies that need to get public are names that you've never heard of. They need to ginny up the marketing engine. They need to be seen. So you got to ask the question, what's happening to the marketing engine? And what we say is that small micro-cap, nano-cap stocks that are generally not known are really in the kind of the crisis zone, okay? And they're having a hard time reaching investors because we no longer have an economic model in this country paying for 100,000 retail brokers to dial and make outbound phone calls and create that visibility. It's also happening on the institutional side of the business. I'm going to talk about that. That's one of the problems that IssueWorks is focused on trying to help correct. Now, this is, if you go around and you talk to Wall Street firms, you get varying numbers, but we believe that at least 80% of the commission opportunity for Wall Street firms is in only 60 institutional investors. Think about that. There's about 3,000 that have to report their holdings to the SEC, And Wall Street's doing an effective job, and probably not even an effective job, we'll talk about that in a second, of covering 60 institutional names. And those names are characterized by two things. They're ultra large, so they have liquidity constraints. Okay, they can't invest in small and micro-cap stocks, or even worse, they're ultra high turnover. They trade. That's how they generate commissions to be attractive. So what we did here was we looked at the fully distributed ownership value, institutional ownership value of the S&P 500 and micro-cap defined as sub $500 million market value biotech and technology companies. And what you can see here is that if you go out to about the first 60 accounts, you're reaching about 65% of the institutional ownership of the S&P 500, a big chunk of it, because it's highly concentrated. They have so many assets under management. But if you want to get up to 90%, you'd only have to reach out to 250 names. So it's a pretty easy exercise for an IR officer. It's actually easier for the IR officer at IBM or ExxonMobil or Google to deal with that population than it is for the micro-cap company and look at it. For them to get up to 90% of their fully distributed institutional ownership, they need to be out to the 1,150th smallest institutional investor when Wall Street stops coverage, effective coverage right about here. So this is one of the problems that IssueWorks wants to solve, which is how do you get to the so-called long tail of the distribution curve? So, we think over 3,000 institutional investors are not reached. Interestingly, sort of like hunting for a needle in a haystack. Sometimes you got to find the guy that wants to do the business services sector, that has $1 billion under management, where they care about small micro-cap investing. It's not an accident that it ended up in their portfolio. It's very, under the current market structure, the old days, just so you know, every single Wall Street firm had a middle market institutional sales department. Lots of institutional accounts were covered by retail stockbrokers because they could make a quarter point. Okay? Today, all that distribution shut down. I can't find one Wall Street firm that has a legitimate middle market institutional equity sales desk any longer, not one. At the same time, markets have become progressively more hostile because there's been an explosion in hedge funds. And so what you see, which is exacerbating the marketing problems of companies in the public marketplace, is that with the rise of hedge funds, okay, this is hedge fund industry, U.S. assets under $1 billion. By the way, what's significant about hedge funds versus mutual funds? They can short. And so the blue tranche here is the percentage of companies that are no longer doing, or percentage of transactions that are no longer doing fully marketed transactions. Back here in the early 90s, okay, companies got on the road, they did a 2-week road show, they went out and met with lots of investors, there was lots of outbound marketing done by the retail side. Every time you did a deal, you broadened the market for your securities. Today, everybody is trying to market their transactions in the stealthiest fashion possible to avoid the risk of having their stock shorted from $20 down to 15 and getting a much dramatically worsened cost of funds. So in the most extreme case, we do bought deals, we do overnight transactions, we announce the deal at 4 o'clock off of a Form S-3 shelf registration, and all in the interests of trying to minimize that short selling risk, or we do something called a wall crossing transaction, a confidentially marketed public offering, where we invite somebody in, they acknowledge that they're going to, without telling them what the company is, and they acknowledge that they're going to be in possession of inside information and that they then can't trade the stock till the transaction is consummated. Okay, but what happens is we now market to the same likely suspects, people that already own the stock, people that are hedge funds that will trade out of the stock. It's a very narrow universe. We don't have the firepower from a marketing standpoint any longer to broaden the market for these securities. So here's the top 50 institutional investors, maybe a little out of date, but I mean, basically the idea won't change, probably gone up now because markets have done so well. But you have Cap Research, the largest, this is assets under management, the largest institutional equity fund in the country, Fidelity, T. Rowe, Wellington, BlackRock, and you can see how quickly the assets under management drop off. Now you can start to understand that if there's a 20-to-1 ratio between the largest and the 50th largest institutional investor, you can start to see why it makes good business sense for Wall Street in a penny tick size environment, 2 cents a share commission if you're lucky, to focus on the guys that have the biggest assets under management. And while the little guys, you know, if it takes 20 of these, this account's worth 20 of these accounts, why they're not going to spend a hell of a lot of time focusing on marketing to the long tail of the distribution curve. So this is the same list of 50 institutional investors in the same order, and we break down their assets under management by what are large cap, defined as over $10 billion in market value, mid cap, $2 to $10 billion is the red tranche, and then when we start to get into small cap, which is $500 million to $2 billion, micro cap. Now, fascinatingly, the micro cap is the green tranche. Take out your magnifying glasses and your binoculars, okay, to find that within the top 50. And that's the problem that the typical institutional salesman has in navigating that part of the portfolio. They do a really lousy job of it. And in fact, many times, like if you're at Fidelity, and the Magellan or the Contra fund comes in, which is very large cap focused, and they have an indication because they want to play the calendar, because they have more assets under management, they will be internally allocated your micro cap stock so they can flip it. Okay? So the question is how, if there's no money in it, does anybody ever get out to the long, long tail? Remember, 3,000 accounts all the way down out the window. How does anybody ever reach that market? So we get down to the 32nd tier. This is actually the 3,200th to 3,299 largest account, so 3,200 accounts. And we just look at how they vary, small cap versus larger than small cap. And you can see that for the typical billion-dollar account, 60% of what they own is small cap or smaller. Why? Because these smaller accounts don't have the same liquidity constraints. They can buy micro-cap stocks in search of alpha, but this entire part of the market is self-directed. Okay, they don't generate enough commissions. Nobody's talking to them. In fact, when I was speaking at the Securities and Exchange Commission Advisory Committee on Small and Emerging Companies, and one of the accounts in the room is Wasatch Advisors. He's on the committee. Institutional investor focused on small cap, micro cap growth. And I think his name is Rob Chase, not sure. I didn't know him beforehand. And I said, Rob, I said, you're exactly the kind of investor that somebody wants on their IPO. You got $13 billion under management. You got a respectable low turnover rate. You're focused exclusively in the growth company sector. And he said, yep, all that's true. They're based in Salt Lake, by the way, but they've got offices in San Francisco. And I said, but you don't get allocations on new issues from Morgan Stanley, Goldman Sachs, do you? And he goes, no, how'd you know that? And I said, because it's math. You don't generate enough commissions to matter. Now, Wasatch, if you look at it, is one of the firms that was involved in the IPO task force report to the U.S. Treasury and been very active in some of these market structure issues. And so what I'm saying is that when we go out and we have a discipline and we're looking at market structure, and I know I got Stephen Wallman somewhere here who is a former commissioner of the SEC and chairs the market advisory, the market structure subcommittee of the SEC. What happens, these committees are populated with people that really are not active investors, fundamental investors in microcap stocks. They don't have the discipline. So when I talk to individual investors about the need to increase tick sizes and economic incentives that are active in these microcap markets, they get it. They understand that it's in their interest to see more deal flow, to improve information effects in markets so that when a phase 2 clinical biotech company has good news to report, that the stock actually trades up to a higher price because people are marketing that there's some liquidity in the name. They get it. When I talk to Micro-cap institutional investors, they get it. When I speak at the Buffalo Institutional Investor Conference, I get people like Evergreen and Lord Abbott, where value buyers come up to me and say, now I understand why I buy a stock and it's cheap and it just gets progressively cheaper and that the stock doesn't move. And I buy it right, has good earnings, nothing happens. Okay, so this is a typical $500 million market cap company, just a data swatch we took. It's actually a SaaS company, software as a services technology company. This is their top 50 institutional investors, fully distributed. And this is that same 50 investors in the same order. And what we did was we drew a line. This is the assets under management that each of these accounts have. So here's Fidelity. The second largest is, in terms of a position here, is Columbia Wanger Asset Management, Waddell & Reed, Allianz, BlackRock, Champlain. And these are the assets under management they have. And we just drew a line here saying, theoretically, we don't think anybody's calling accounts that have under $50 billion in assets. And so you can see how this highly fragmented long tail becomes so critically important to the typical micro-cap company. So just for you and I, we announced that we were doing a private placement. We're in the midst. We've got indications of interest now starting to come in. For those of you that don't know, I think I mentioned we left. We had a strategic relationship with Grant Thornton, which we ended on September 30. We're hyper-focused on doing this. We kind of really kicked off the private placement probably the end of October. And what we're looking to do is to empower Wall Street. Our clients are Wall Street firms. We're in discussions with a number of them right now to service them, to help them reach the long tail. Because when I get into conversations with them, they literally will tell me, behind closed doors, I don't want to rat anybody out, that it's just not it's an opportunity cost for them to start making phone calls to the long tail of the distribution curve. Because the commissions are so skewed to those larger accounts that if they're trying to get a deal done and they start taking their salesman's attention to do what is effectively cold calls, right, that it ends up actually costing them money. So the salesmen, unless they have a methodology in place to ensure that those calls are getting made, they end up not getting made, and that's one of the reasons we believe that if you go all the way back to the beginning, you've seen this decline in the IPO success rates, the canary in the coal mine. The distribution has so dramatically shrunk that it isn't doing the heavy lifting that we need it to do. So there's two ways we're going to fix that problem. One is IssueWorks through technology to automate and drive down the cost of reaching the long tail of the distribution curve. And the other one is campaigning to get Congress to see the light and the SEC to see the light to increase tick sizes and economic incentives in small and micro cap stocks to get market makers and institutional investors more of that long tail of the distribution curve, more engaged in investing in small and micro cap names. Just so you know, we had a proof point. We did this about 3 years ago. It was a eureka moment for me. We had a book running manager, well-known boutique investment bank. The CEO brought us in and said, Dave, you've forgotten more about this stuff than I'll ever know. I ran equity capital markets at Proof, priced 500 IPOs, about 500 follow-on transactions, and then oversaw banking research, sales, and trading strategy for the firm. And what we thought was they weren't reaching the long tail of the distribution curve. They told us, since they're a growth investment bank, that they cover everybody that's relevant. And we said, just humor us. CEO said, I'm afraid everybody's telling me I'm not going to get this deal done, and I've got a lot of commitments out to a lot of senior staff. I can't afford not to get it done. So we went and did a quantitative work against the long tail of the distribution curve. We found 250 investors that we thought were relevant. We put in a program to reach out to them. We got small open rates on the email campaign that we put together. But from that, we were able to actually more than double the size of the institutional book and find 3 accounts that ended up becoming their 3 largest institutional investors. It totally changed the complexion of the deal. So for us, it was a eureka moment. We said, oh my God, if we can do that, given that we did it with bubble gum and Band-Aids, that we should be able to triple, quadruple, quintuple. the distribution on new issues. And this is actually an easier problem and an easier sell for already public companies. Why? Because public companies already know the dysfunction in the public markets. They already know that a lot of the meetings that they're taking through the investment banks are not in their best interest when management is being asked more questions about by institutional investors about what their competitors are doing. Okay? And the reason is, like, if you're a $500 million market cap company and you don't fit somebody's portfolio because of liquidity constraint reasons, then they're going to use that CEO, CFO as an expert witness to tell them what's going on with the trends in their competitors. It's a research meeting, and it grinds small cap, micro cap companies effectively to a pulp. So in a nutshell, that's what we're doing. I'm going to exhort everybody in this room. This is your country, okay? Okay, it's an embarrassment that we are doing, an average of 165 IPOs a year since the dot-com bubble burst, okay? On a GDP-weighted basis today, we should be at 900 IPOs. Now, a lot of people will tell you that most IPOs will fail and lose people money. That's the truth. But I want to leave you with a thought, okay? In 1971, there was an $8 million IPO done. The company was 3 years old. It was not profitable on an operating basis. It missed delivery of its first new product out of the box. That stock was cut in half. So now it's trading with a $4 million float. You know what company that was? The Intel Corporation, okay? Every company in the S&P 500 starts small, okay? So if you don't have a capital formation engine to support the entrepreneurial economy, then it shouldn't surprise people why we have a job creation problem in this country, why we're throwing people out of work, why there isn't demand, if you will, for services in the audit profession, in the corporate law profession, okay? This is a classic self-inflicted gunshot wound of the first order, and every one of you can't be apathetic. Every one of you has to go out and get the problem fixed, okay? Write your congressmen, write your senators, write the SEC. They read the letters, okay? Thank you.